Joining us now, Jim Paulsen, Chief Investment Strategist at Leuthold Group. Mike Santoli, CNBC Senior Markets Commentator. I'm going to get to you in just a second, Jim, but I want to whisper something to Santoli. It's October 20th, and nothing has hit the fan.
October 21st, yeah.
Is it? See, I mean, I even missed it. But nothing has hit the fan, and
right.
It's October. And that I always worry about the teens. The Ides of October always worry me.
Yes.
It hasn't happened this time.
A little bit of chatter that, we have after the options expiration last Friday, maybe there's going to be a little bit of rumbling. But no, I mean, the market has been very, very calm at the index level. We kind of got a lot of that choppiness front-loaded in August, and I think what we're doing right now is kind of figuring out if August was, just a little bit of an overreaction to these signals that we're having too much of a slowdown, or if that was a little bit of a tremor.
Did you read Paulsen's stuff?
Sure.
Oh, you did? Okay, because I was thinking, wow, you're a genius. Because Paulsen, that's exactly what you're going to say, right? You got that the recession fears peaked in August, and since then, things have been... I think that case is not nearly as compelling anymore based on the data we've seen, and that's why things are acting a little bit better. With you, I was going to say you've been waiting for good things to happen, and the jury's still out. I mean, we're back right around 3,000 on the S&P, and I honestly don't know. Do we head back to 2,700 or finally break out and go up? Do you know?
I wish I knew, Joe, for certain. You're right. I've been waiting a while. This recent high this year has been tough to break, and we'll have to wait and see if we do it here now amidst the earnings season. But I kind of think that that the fear we had in August was pretty immense, and it took yields down to extraordinarily low levels. It inverted the yield curve. It dumped commodity prices. It killed off international small cap cyclical stocks. And what you see since that sort of fear crescendo peaked in August is a lot of the trends in the markets have changed. So you're really seeing a huge upward move in bond yields going on, not only here, but globally. The German bond yield is up, the Japanese 10 years up. Here it's up, and I think that's a big sea change. The yield curve inversions, two important ones, have been completely eliminated, removing some recession fears. Overall, even commodity prices, the CRB all spot price index has lifted one of its biggest upward moves this year. And then in the stock market, you're seeing a big outperformance by international stocks here over the last 2 months, which is something that just hasn't happened this year. And you're also seeing a little better action from small caps and from cyclicals overall. So I do think there was something that switched around that August fear crescendo that might continue to play forward. And I think right now, in addition, we've had better economic reports over the last 2 months coming out a little better than expected. We're probably just finished up another 2% quarter here in the third quarter, where we started, I think if earnings or economic reports have been coming in better than expected, then I think earnings reports might prove to be better than expected as well. So I think it does key on earnings. If earnings continue to do a little better, then I think we're going to finally break the glass ceiling here of 3,025 in the S&P and maybe challenge 3,100.
Did you know all that? I mean, you have looked at a lot of stuff. There's not much to do up there in Minnesota, I guess. I mean, you got the Vikings, I guess, but. Wait till it's 40 below.
Till winter, Joe.
Wait till it's 40 below,
time.
and you don't even. But did you know? Did you realize that about? Have you
I'm pretty much tracking all those trends in terms of how.
And you're in New York. You have things. You have a life.
That's true.
Basically.
They have, 10,000 lakes.
No, they do have 10,000 lakes. They're all frozen over. But.
What I would say is, in terms of the overall index being a little bit, either it's resilient to all these concerns that Jim was just going through that we went through in the late summer, and it was, or it's kind of sputtering right here. But look at the high growth stocks that people were loaded into going into this phase. Software down a couple % last week. That's why the overall index is stuck, even though all the kind of cyclically geared stuff in the financials and the foreign stocks are doing better. So that's why you want to look to Microsoft, Visa, Amazon this week, and Chipotle, not because they say so much about the economy, because the reaction to those reports will tell you if the character of the market's changed or not.
And the Fed might pause, possibly.
Possibly. Well, that could be the
pause after October.
Maybe because of what the Fed futures are saying, but it's being talked about, I think, Jim. You don't think they should go down, do you?
I think, personally, Joe, I think if the Fed paused, it might not be all bad. I mean, because if they do pause, it'll be because the bond yields are going up and the reports are strong enough to support higher rates. I mean, look at the 10-year yields pushing 180 this morning, funds rates at 2. I think it'd be okay if the Fed wants to cut the rate to 1 3/4 and eliminate that 10-year to funds inversion. But the much better result would be, let's say we get a manufacturing ISM which turns up unexpectedly next month, and the 10-year yield goes above the funds rate all by itself over 2%. That'd be a much better result for building confidence and bullishness in the stock market than if the Fed has to cut again.